Alright guys, welcome back to another video. This video is going to be about how I execute my trades that literally pay me to buy stocks, and most of the time I never actually have to buy them in the first place and I just keep the money. This sounds like clickbait, but I promise you it is not. This is not gambling, it's not prediction, and it's certainly not day trading. What people mess up isn't the strategy, it's the execution. So in this video, I'm going to break down exactly how I execute my cash secured puts and covered calls the right way. This video is actually coming from a comment I got from a subscriber asking me to break down exactly how I do the executions on Interactive Brokers, which is the platform that I use to execute all of this. So we will be using IBKR to actually showcase how these orders are set. But before we jump into Interactive Brokers, we're going to be looking at the chart to go through these small steps before we hop over to the actual order execution. So step one obviously starts with the intent of this. Before I place any trade, I decide what I actually want to happen. This is going to be if I'm selling a cash secured put, where am I happy owning this stock at? Or if it's a covered call, am I okay selling the stock at this price? If you're not comfortable with any outcome, do not place the trade in general. The key thing here is execution starts with being honest about what you want and not chasing the premium prices here. So talking about how I actually execute the cash secured puts, because that would happen before a covered call is sold. First thing is going to be obviously only picking quality names. In this particular example, we are going to be using Interactive Brokers. I do have another stock that I will go through later in the video with better premiums, which I will explain after. But you have to be comfortable owning 100 shares of any given stock. Obviously, the stock needs to have liquid options chains. And obviously, you're never selling a cash secured put on stock that you do not want to hold for the long term. The key thing here is if assignment scares you, the stock choice is wrong. So the next thing you're going to be doing is choosing a strike price to actually set the order up at. Essentially, this is just where you're buying the stock at if it gets to that price. That's what all I mean when I say you're selecting a strike price. You're choosing a price you'd actually like to buy the stock at. Usually I like to do this at a key support level like these that we have many of them right here on Interactive Brokers, or you can use a consolidation level as well. It just depends on the chart and what the chart is showing me. You know, strike selection matters more than premium size, so I would pay more attention to that than chasing those big premiums that you can see on Interactive Brokers. So hopping over to Interactive Brokers, this is what it looks like here. You can see that we're on IBKR's stock in itself right here. We can go over to, instead of the chart, we're going to be looking at the options chain section right here. Let's make this bigger actually as well. Before we actually get into the execution of an order, I want to show you guys expirations because these are so important. But before we get into actually choosing a strike price and setting up an order, I want to talk to you guys about expiration first, because this is where most people mess up. So there's three ways that I like to mainly think about expiration, and each one directly affects how aggressive your trade will be, how much buffer you want, and what percentage that you're targeting. So first of all, we do have weekly expirations. Obviously, you can see right here, it says it expires in 6 days. We are recording this on Saturday, so by the time Monday hits, it's like a 5-day expiration really. With a weekly expiration, you're looking at a shorter time in the markets. This means there is a faster time decay and there's less time for the stock to move against you or for you. This is where you're usually targeting about 0.5 to 1% per week, but it requires a lot more attention. Personally, I like to use weeklies when volatility is elevated, I'm confident in certain levels, and I'm okay managing a trade. Obviously, I have a lot more time because I do this absolutely full time, but for those investors that are maybe just starting or they're not used to this, I would like to see you guys playing with some stuff further out, which I will explain after. Weekly options pay more per unit of time, but they demand a lot more discipline and sharper entries. The next one is going to be the monthly expirations, and all we're going to do is count out the weeks here. 1, 2, 3, 4 weeks expiration, which means this would be the monthly expiration of an option. This would mean there's more of a time buffer, strikes can be further away, there's going to be less stress and micromanagement on your trades. This is where you can kind of start to target like a 0.3 to 0.5% return per week, which overall would average to around like 2 to like 3% maybe per month gains. This is obviously where consistency is much higher. I use monthlies when markets are choppy, big data is coming, or I want a smoother execution on my trades. It's more so for peace of mind with slightly lower weekly returns, but you do stay a bit safer. And I'll show you guys on what that means on the chart right after this. But finally, if you are playing expirations that are over 4 weeks out, this is a very defensive play right here because that is the maximum buffer, lowest probability of assignment, and the least active management. I haven't used this since I was just starting out, but this is where you would look for longer expirations when the market is uncertain, macro is very mixed, or I really don't want to babysit trades. But longer expirations are about survival, not speed at all. I personally don't use them, but to each their own. The important thing here that people need to understand is that expiration selection is not fixed. Some weeks, if I want to push for 1% per week, I will flex over to the weekly expiration. Other weeks I'm perfectly fine running a monthly with a 0.3 to 0.5 weekly return. This all depends on volatility, upcoming data, and my confidence in the market. The key thing here is your target percentage should match how comfortable you feel, not what looks good on paper. So when it actually comes to placing an order, we're not just going to blindly look at the premiums right here. We're obviously going to hop over to the charts. So the subscriber did request that we use the Interactive Brokers Group stock itself, which is pretty funny because obviously we're executing this on Interactive Brokers. But the first thing I want to see is support levels, which we do have a lot of, like I pointed out before. The only thing with this is we are trading at all-time highs. Now this is due to earnings. As you can see, we had this big wick, reject, and pumped. We actually pumped almost 11% from the day where the day started and where it ended. So for me, this is I would say it's a bit of a red flag currently. That doesn't mean that the stock in itself is a red flag at all, just where it's currently trading, because you do have a high chance of the stock kind of rebounding, filling a bit of these gaps, and then continuing to the upside. This would be a good play, if you were looking at this support area right here, because if you are trusting that we are going to continue to the upside, as we can see, the earnings did look pretty good here. We can take a look. They did, have a surprise beat, which is really good. And obviously that's pretty optimistic for the ticker and the company itself. So you can speculate that we will be continuing to the upside with this. So if you did place a cash secured put at this area at $73, you might not get assigned. You obviously can't tell for sure depending on how low this actually dips after its earnings. But personally with this, if you place it here, this would be a good spot for a possible assignment and then having a stock gain to the upside. But for this example, we'll use $73 as our strike price. I'll show you guys the difference between weekly and monthlies. So coming over to Interactive Brokers, we will be using the weekly expiration first. As you can see, that's just going to be for the end of current week that's coming. So that's going to be January 30th. And then we're going to find the strike price that we had set on the chart. So if we hop back over, $73 is about just where we were looking at here. And we're going to find 73 here. Now don't get confused because calls are on the left and puts are on the right. We're going to be looking to sell a put, which means we're clicking right in the bid right here. So when I click this panel should pop up right now showing that you are going to execute the order. So a couple things to note here. These numbers are not random. They're not here for show. These actually show you the premiums that you'll be earning for selling this option with this expiration in particular. So what this means is you will earn between the bid and ask is 0.15 to 0.30. All we're going to do is always take the mid of those two, which will be around 22, 23. Anything in between this is great. The closer you get to the midpoint exactly, the more of a chance that you get filled at the best price on this. That's just my rule of thumb. You could obviously do whatever you want. I never really use market orders unless it's like a last second thing that I really want to get filled at, or if the premium is dropping very quickly, because obviously when the market is open, this is continuously fluctuating. And obviously this can change a lot depending on what's happening with the stock. So sometimes use market execution orders, but I can make a separate video on that stuff. But specifically in this example, you guys should only be using limit orders. So with this, what you're setting right here is how much you're actually getting paid. So obviously for this, you can get paid anywhere between 0.15 to 0.30 per share. Remember, this is always per share. So obviously with options, they work in blocks of 100 shares at all times. There's never going to be a time where you're doing this where you're dealing with less than 100 shares. You can have more than 100 shares if you're selling right here. Quantity, 1 means 100. 2 would obviously mean 200 shares, 3 means 300 shares, but for now we'll just stick with 1 for the purpose of this actual example. So with this, see how it says credit right here, that means estimated total right here, $23 US. So to sell a cash secured put at $73 on the chart, which is right here, expiring at the end of the week, we will get paid $23. So with the expirations, all we're looking at here is we're saying we agree to buy 100 shares of stock at this area. If over the course of the next week, we just continue lower and then higher and stay out of the money here, this means we keep that $23 and nothing happens. But on the flip side, if this stock comes down at the end of those 6 days, we are at this level or below it, that means we are expiring in the money. And this means that we will be assigned 100 shares of stock right at this area right here that we've already set, $73. And as you can see on IBKR, $73. But if we did this on a monthly level, like I said, we were doing this weekly. If I hop over to 1, 2, 3, 4 weeks being 1 month, and we use that same level, click right here, let's wait for this to load, we would actually be paid anywhere from $1 to $1.25 per share. Obviously, we selected the mid price. It's going to be somewhere in between the two though. So I just selected 112, for example. Now, this means if we decided to do this on a monthly basis, so for 4 weeks, we have this position, we will earn $112. So we have the same execution strike price right at this area, but we're saying we're going to hold this for a month expiry. So now this stock has a month to either come down below, come above, do whatever it wants to do, but it's only over the course of a month. So you can see, so if we were selling those weeklies like I showed before for $23, and we did that every single week for the next 4 weeks, that's 23 times 4, which is about $90 that we would be earning. But if we just sold a monthly in the first place, we have more of a buffer, and we actually will earn $112 instead of around the $90. So for in this case, a monthly would actually benefit us because we have more time not to get assigned the shares. If that's the goal, if you don't want to get assigned on the shares, it has more time to kind of come down, do its thing, and in this case specifically, fill this bunch of orders from earnings and then continue to the upside. The worst could happen. You could crash all the way down through these levels, but this would happen over the course of a month instead of a week where you got to sign these shares and then, you're coming to the next week and you're already down, like 4% down from here to this level. So this is kind of one of those things where you have to understand what you want out of the stock. If you want to be assigned these shares at a lower price, 100% you can play it like that. But if you're looking for more of a premium chasing game, you don't have to get assigned at all. You can push that date out a little bit farther to the monthlies, earn a little bit more on the premium side, and there's a less likelihood of actually getting assigned the shares at the $73. So the further out you go, obviously, the premiums do get better. So it does kind of matter how you want to play this. Obviously, this was $100, this was $23. So you can assume these would just be the in-between with that same strike price. So if we were using this example right here, let's go back and do the 23 cents right there. Again, and you can see $23. I like to use GTC, which means good till closed. All that means is this order will not expire until I manually close it. That's it. There's nothing, to do here. If you're using day, obviously it will expire at the end of the day, but I will be using good till closed. It'll only expire when I close the trade. Once you have all this and it's looking correct, remember, always click on the bid, not the ask. See how it says buy order? We are not buying puts, we are selling puts. Once you filled all of this in, you submit the sell order, and that's it. Your trade has been executed and you are good to go. And the thing is with this, you're not chasing fills, because bad fills kill good strategies. If there's no fill, that means there's some information that you have to be looking at and have to adjust your strategy. And obviously, while this put is open and waiting to expire, I'm not really just staring at it. I'm monitoring the headlines and the market structure, and I'm letting time do the work here. There's no emotional adjustments. You've already done the work getting to this point. Now you're more so monitoring the chart, seeing what it's doing, the structure that it's forming, and the headlines that go along with this particular stock. But getting into expiration, like I said, if this put expires worthless, this could be your ideal outcome. You keep 100% of that premium and your capital is freed back up. In this case in particular with IBKR trading at $73, remember, we're always dealing with 100 shares. You're tying up $7,300 to make that $23 gain, or if you were looking at the other one, that would be $112 gain that you're tying up the $7,300 for. So the way I like to measure things around here is actually by percent gain per week. If I'm targeting a 1% gain per week, we can basically just divide the premium, so 23 divided by 7,300, multiply that by 100, and that gives us around a 0.3% return. Now that isn't the best for me particularly. Obviously, this premium is a bit skewed just because we had this massive pump like the last day, or just on Friday before the market closed, obviously. So the premium is a little bit skewed, and I'll give you guys a different example of this. But 0.3% isn't something I'm interested in targeting on a weekly basis. If I'm going aggressive, I want something around 0.5 plus. I would actually aim for something around 0.7 to 1%. On a weekly basis. But the cool thing is with those monthlies, you can actually take that overall, if it was 112, you can divide that by 4, see how much you'd actually earn per week, and that sometimes does equate more than that 0.3% gain, and say that's a 0.5% gain, just by using a monthly. Instead of selling one of these per week, you just sell one overall, and you're actually earning more over the course of those 4 weeks. But getting back to assignment, again, assignment is not failure. Assignment just means that you've been assigned 100 shares at the price that you've chose. So you're just getting 100 shares at this price. Again, this is one of the situations where you did this because you wanted the shares, the premiums already reduced your cost basis, and then now we start selling our covered calls. Before we hop over to IBKR, what you have to remember with covered calls is I only sell them at prices I'm happy selling the stock at. Cash share puts are for the way down, covered calls are for the way up. Covered calls cap your upside, and intentionally, if you're saying I will sell at $76, which is about right here, you're capping your gains here. In the week, it could rocket 20% to the upside, but you've sold your gains right here. So you have to be very careful with that when you're playing with covered calls. They're a very tactical thing to play. Again, when it comes to strike price with this, I do like doing this where either we're using previous highs, for example, or there's going to be a resistance area, which is just these green, obviously, and red above. that's just a good spot where I would see price kind of like rebound off of, maybe have some trouble getting past. And by placing a covered call there, I'm actually gaining the premium and I'm making the stock percentage. So if we got assigned the shares at $73 and then we traded this all the way back to the recent highs, that would be a 7.13% stock gain, which is at around $78, $79. So since IBKR is trading at like all-time highs, it's not a great way to show you guys how to sell a covered call properly with the proper returns. So what I'm going to do is I'm going to show you guys this on Robinhood, because I do own 100 shares of Robinhood at the 108 mark. So I'll show you guys on IBKR what that actually looks like and how to sell this properly. Now, one thing I need to preface for you guys is that Robinhood is a different stock. It does have different volatility and it does have different options chains. So what we're getting over on the IBKR stock is going to be different in terms of what the Hood stock is looking like in terms of premiums. So what we're going to do is actually check where I would want to sell this at. So if I go over to the chart, if I wanted to make a 5% gain from where my shares are, that would be at about 5%. We can actually use this resistance level because I was saying that before. So it'll be a 3.4% stock gain, and we're going to be selling at 111, closer to 112. So what I'm going to do is I'm going to look for 112 on IBKR. And once I find that, we're going to click on the bid again. Remember, because we want to pop up that sell. We don't want to click on the ask because that shows a buy order. We're always selling. We're either selling a put or we're selling a call. So this would be for the weekly. So what I'm saying is, hey, I'm looking to sell my shares. I want to cap my upside on this. And what I'm going to do is put in the covered call here. So between 1.09 and 1.12, remember we set that limit price at something in between. That's like 110, 111. So if we're agreeing to sell the shares, I will make $110 US. That's not the end of it. We're also getting a 3.44% stock gain along with that $112. And all you need to remember for this is you are essentially making a promise to sell your shares, and that's what the market is paying you for. Assuming that IBKR does come up to this area and expire in those 6 days, like I said, we're using a weekly, we will get those shares called away at this level. If IBKR stays below this area and does not in the next week, that means we will expire out of the money and we will have to rerun a covered call. And the only difference with this would obviously be for a monthly covered call. And if we go back and check, we can actually see at the 112 mark where we were selling it before, we'll actually earn $500 for selling it, but obviously this is split over the course of the month. So if I'm comfortable holding IBKR stock for the next month, saying, hey, I'll hold this for the next month, but it has to come up above this level and stay here after a month. Remember, it has to expire here. It doesn't just pop above, we lose the shares. It has to pop above and stay above this area for the foreseeable future until my option expires. So depending on how you feel about the stock, obviously, what your strategy is with this, you can choose between, 6 days, 13, 20, and 27. I will actually be making a video this week because I actually do need to offload these shares. I will show you guys exactly what I'm doing and how I'm playing this in particular. So obviously the outcomes with this are it expires worthless. Again, you just keep the premium and you walk away. You don't actually sell the shares. You can just run them again. But if the shares get called away, you get the stock gain, the premium gain, and you get your capital freed back up. So again, you're getting paid on the way down with cash secured puts and you're getting paid on the way up with covered calls. So some common execution mistakes here is obviously chasing premium instead of price. You could, sell a cash secured put at a certain level and then get super excited for it. And, this doesn't always go the way that you planned. You're forcing the trade based on how much you'll make, not where you're looking at it on the charts. If you're selling cash secured puts on stocks you don't want, that is the fastest way to get into a losing trade. If you're forcing trades every single week that you just don't understand, definitely don't do that. Obviously, one big thing would be selling calls too close to current price because, especially if you're setting these up on the weekend, price can easily just gap right below in the morning if something happened over the weekend, and then you're like almost instantly assigned on your options. So there's nothing worse than waking up and seeing that you're already below and in the money on a cash secured put. And then the last thing would be over concentrating in one sector. If you were running this all, in tech or something, this is not exactly what you want. You want to be diversified just as you would be with a regular portfolio. But overall, options do reduce my pressure for swing trading and my day trading. They work while I wait for my macro alignment, wait for my setups to present itself. Swing trades happen very selectively, so keeping my options consistency very high is very nice, and I really do enjoy it. Execution is just kind of what makes it boring and profitable. but this isn't free money. It requires capital, patience, and a lot of discipline. But when execution is done correctly, trading stops feeling chaotic and it starts feeling very, very repeatable. If this video helped, I'll break down real executions next, wins, losses in the next video, so you guys can see exactly how this works in practice. I usually make videos every single week of the current positions I'm in, but let me know what you guys want to see in the comment section below. But if you found value in this video, leave a like, subscribe, and we'll see you guys in the next one.